Probal Sen from ICICI Securities as well joins us on the show right now. Probal, hi, morning. Thanks for taking the time out. Probal, the legacy O2C business clearly has managed to do the heavy lifting. It was clearly, lower feedstock which managed to aid the profitability. But is this an assumption that the markets were working with already?
To a certain extent, yes. I think there was a certain amount of OTC strength that was built into estimates. If I look at consolidated EBITDA that was reported, that was broadly in line. I think Somit mentioned that the beat in net profits was also driven a little bit by the kind of tax adjustments that happened. So while it is a strong set of numbers, I wouldn't say that it was a huge positive beat versus what the street was looking at.
Probal, hi. Just wanted to get in your take as to what the outlook is when it came to the company's retail performance as well, because we did see store expansion this time around. There were higher footfalls that did manage to aid the retail growth, and the net store additions as well have been strong. Do you believe that the retail vertical is likely to propel growth? What are you penciling in?
Frankly, the numbers from the retail segment are staggering. I mean, if you look at it, in a country like India, to sort of get to 65 million square feet plus of area under coverage, and more than 18,000 stores across formats, I think that's a pretty phenomenal achievement, whichever way you slice and dice it. The company has stated very clearly that the capex momentum will continue to be front loaded in this segment. They'll continue to be fairly aggressive in terms of infra rollout for the retail segment. So I would not really be surprised if mid to high double digit, revenue and EBITDA growth is something that we continue to see from this segment, at least over the next couple of years. Obviously, going beyond that is a little bit difficult to understand today, because we don't know what format will actually work and what the mix is going to be between offline and online, because that's what the online part of it is also something that they have been really focusing on, and that continues to grow exponentially for them. But on the overall level, I think the retail business should continue to be a significant growth driver for RIL's earnings for the next 2 to 3 years.
Management indicated that they're going to maintain their net debt to EBITDA below 1 time. But you think with the kind of massive expansion that we're hearing from the Reliance stable and pretty much across the board, especially retail, is that still a concern with the market as to how comfortable the debt levels would be going forward?
I would say I would definitely think that it's a little bit of a concern. It's one of the fundamental reasons why we do not, we continue to be a little bit cautious on the state of FCF and return ratios on the business for the next 2 to 3 years, because the net debt number as reported in the presentation actually does not include spectrum liabilities, which pretty much double the level of net debt straight off if you really look at it. The 1,10,000 crore number that's presented is reported in the presentation is actually excluding the spectrum liabilities of 1,10,000 crore. So when you add that up, the net debt to EBITDA is actually at a fairly high level, and the capex number of 1.4 trillion is well above, I think, most street estimates. If you had asked at the beginning of the year what people were penciling in, including us, I don't think even the most aggressive assumption would have penciled in more than a lakh crore of capex across the businesses. So, I beg your pardon. So if you look at the kind of, as I was just saying, the intent of the business, the intent of the company is that they're comfortable with the front loading of capex that is happening across 5G infra, across the retail business, as I mentioned, and now with the additional petrochemical expansions that were announced in last year's AGM, those will also start to reflect in the next couple of years. Plus, new energy business hasn't really started seeing capex at all, and there's another 80. So if I look at the next 2 to 3 year capex program, very easily 1,10,000 to 1,20,000 crore run rate will continue. So while earnings growth continues to be peer leading, I don't think return ratios will go to double digits or stay there for any period of time. And that remains a little bit of a concern, given that valuations are already at 16 to 17 times 1 year forward earnings, depending on whose numbers you're looking at.
Just a quick word, Probal, on the stock price of Reliance Industries, what you're advising?
We have an ad rating on the story. We do believe that the earnings growth merits a look at the stock, particularly at these prices. But our fair price of 26.50 already builds in mid-cycle, EV EBITDA multiples for the OTC business, fairly aggressive, 35 to 40 times 1 year forward EBITDA multiples for retail, about 7 to 8 times 1 year forward EBITDA for telecom, and 1.5 times EV to capital employed for the new energy businesses. Unfortunately, that EV reduces a bit because now the net debt number is higher post this quarter results than it was earlier. So we have had to downgrade our target price from 2,800 to about 2,650 levels. So that's where we are. Yeah.
Okay, Prabal, great to have you on the show as always. Thanks for taking the time out.